Welcome everybody. This is Spinnaker Investments Quarter 3 review. My name is Morgan Christen, Spinnaker Investment Group. So what I'm going to do is I'm going to take you through what happened in the last quarter, the third quarter, and look at some of our thoughts as we go into the fourth quarter of 2021. So the third quarter was pretty lackluster, as you'll see in this chart here, pretty flat. A lot of things came about. Interest rates moved a bit. We saw some inflation type things, oil going up, supply chain issues, but overall just pretty flat quarter as far as markets are concerned.
You've got no arms left. Yes, I have. Look, it's just a flesh wound.
But, you know, the good news here, just like in Monty Python's Holy Grail, it was just a mere flesh wound, meaning that most markets were not hurt that bad. We had the S&P 500, the U.S. market, just call it flat at 0.6. Some of our smaller company stocks, which tend to be a bit more susceptible to interest rates and the economy, were off about 4%. And then you look at the international, both the developed and emerging markets were off a bit, with the emerging markets being off about 6% for the quarter. Bonds flat, pretty much across the board, except for international developed bonds. They were off a bit. So overall, not a great quarter, but really not that bad. It wasn't like a major drop overall. Now, when we look at the U.S., what did well in the U.S.? Well, it was mostly larger growth companies, with the smaller companies at the bottom. And you'll see on this slide here, even with somewhat of a pullback on smaller stocks, not a bad year to date in those areas, except for small growth, small value having quite a good year so far. So again, large companies in the U.S. look pretty good, large growth mainly, with smaller companies not having a spectacular third quarter. Now, it was the opposite when we look internationally. So this is developed markets. We had the international small caps were actually the leaders with the growth and value, and some of the larger companies towards the bottom there. And you'll see in this chart here too, once we adjust for the currency in their local currency, they actually looked somewhat worse. But overall, they felt it a bit more than the U.S., the international markets. And again, the emerging markets felt the brunt of it. So across the board, smaller companies, larger companies, all of them were hurt. But much like international markets, although they were down, the smaller companies looked a lot better than larger companies in the emerging markets. Now, year to date, we look at some of these areas. Small cap is leading emerging markets with their larger and larger growth towards the bottom. So when we look at different markets, we had Austria at the top, and we had Hong Kong at the bottom in the developed markets, and then the emerging markets. Argentina was our top performer, and Brazil was at the bottom there. So, you know, it's just kind of an interesting look at where things were. Some of it is commodity based, some of it's just things going on in their different countries. Now, real estate investment trusts actually look pretty good. Domestically, we were up a bit. Year to date, they're looking really good. Internationally, not so much. But you know, one thing that everyone thought that people weren't going to work, so we had commercial and buildings and things like that looking bad. People weren't going to malls, but you look at companies like Simon Properties. They have malls all over the country. They have some down here in Orange County, California, and you know, companies like that were up about 70–80% for the year so far. So there has been a nice little movement to the upside in real estate. Now, again, that's not any of your personal properties. It's more commercial. But, you know, when you look at the last quarter, like I said earlier, you know, it was a mere flesh wound. Third quarter in most markets tends to be the worst quarter. You look here, the Russell 2000, small companies tend to have a bad third quarter. Growth or technology in the NASDAQ tends to have a bad third quarter, as does the S&P, which is pretty heavy in the technology area right now. So third quarter tends to be a bad one, so we're glad to have that over with. And as we look into the fourth quarter, you know, it looks pretty good. In most markets, fourth quarter tends to be a pretty good quarter for markets. Now, commodities, This has been a hot topic because of people's concern with inflation, and there is certainly some inflation out there. But you'll see at the top there natural gas, and that's many reasons, but some of it is because there's a shortage. We have supply chain issues there. Also, our look to get greener and greener. We're seeing that producers aren't producing as much because it costs a lot to develop some of these properties. So this will be probably a pretty tight year for some folks, especially in the East, as you look at natural gas prices bumping up. And then fixed income bonds, really, they did not go anywhere. Interest rates changed mildly, if anything. The U.S. pretty flat from last quarter. You look at the U.K., pretty much the same. Germany, you still have negative rates for about the first 10 years. So you give the German government your money and you get less back, at least for 10 and under as far as maturities. Japan, they have some negative yields on the front end. But then Canada looks much like ours, and as does Australia. So now looking forward, as we look into Q4 and actually beyond, let's look at the things that look good and maybe some things that we could be concerned with. So I found an old photo here. This is a crowded restaurant in 2019 BC. That was before Corona. One of the biggest things to some of this recovery, and as far as the economy and the market, is that the lowering of the COVID cases. So when you look at some projections, we're starting to see that drop off, which is great, and people can get back to work, and people are more comfortable going places. So things are looking better, but one of the biggest things that we see right now is the fact that that is slowing down the cases of corona, and that the chart is something that looks attractive. This is one time when we want the chart to be going down. We love stock charts going up, but certainly the corona case is going down. That looks good to us. So also Peter Gibbons in Office Space, I don't know if you remember, but he says, nah, not really. I'm just going to stop going.
I don't like my job, and I don't think I'm going to go anymore.
Well, people have really stopped going to work. There was 4.3 million people that just decided to quit last month, September. So they just stopped going to work, and some people are now working again, but many people just haven't come back. And so some of that is structural. Maybe they were you're older, their 401k was up, their house value was up, maybe they sold and decided to retire. They're done with it. But some people got a new job with a higher wage, but some people are still not going to work. So it's really kind of an interesting scenario right now. You look at the working age population, and other than maybe Africa, most developed countries are really seeing less and less participation by the marketplace, meaning that most people aren't going back to work. We're seeing working participation dropping in most countries. Even China's soon going to go negative. And as you'll see here in North America, they're down. Europe, a lot of those areas are seeing less and less worker participation. So other than Africa and India maybe, where we see positive, it looks like this could be something that's going on for a while. And what's interesting is right now we have this crossover. We have a crossover in actual jobs that are available. Job openings have crossed over people, actually the unemployed people. So it's an interesting thing. There's more job openings currently than there are people looking for employment. So it's an interesting thing to watch because it ties into inflation, it ties into growth economically, and so it's an area we're watching and watching closely.
They're here.
They're here. I don't know if you remember from Poltergeist, little girl staring into the screen, and they were here. So what's here? Well, we're seeing some inflation. So we saw that especially in energy. CPI, the index that's tracked for inflation, has been moving forward. And you see it in stocks. So the energy sector outperformed solar sector. So we're seeing the energy stocks moving forward. We're seeing them moving up. That's generally inflationary. You look at this chart here. Good news is that the manufacturing index has pulled back a bit. So there was some inflation on that side. But the one next to that is that's wages. Wages have gone up. Wages are an area where you can't pull back. Once wages go up and that inflation starts happening, you can't pull that back. However, the caveat to that, though, is that the last 20 years there's been essentially no wage growth. So yes, it's moving up, but it's getting to areas it should have been a while ago. And then also you'll see on here too rent. So rent has gone up quite a bit. And while rent can adjust, it generally doesn't adjust back down much. Social Security. So those on Social Security are going to get roughly a 6% raise in 2022, and you'll see here that it's been a long time since they've ever had a raise like that. That's following some years of some zeros and some 1-2% adjustments, but now pretty darn near 6% a bump in inflation for 2022. Now, a lot of that is you look at inflation, you look at where bumps have come from, and you've seen it from used vehicles. Well, why is that? Well, you look on anywhere on the internet and you see all these cars, these new cars ready to be sold, but they can't be because they're missing chips. So there's been a flood of folks looking at used cars. The used car market has gone up. Shelter, that's we all started looking at our houses as now our office. So cost of housing, cost of rent, a lot of that has gone up. You see that early in the center. And of course, food. So as oil and energy cost more money, that means fertilizer costs more because that comes from petroleum, and all of a sudden you see the byproduct coming out of food, especially like areas like meat and poultry, all these different areas here, more and more expensive when you go out to eat these days because of some of these issues with not only oil but supply chain. But also you look at the 10-year, we're seeing some inflation, but interest rates aren't really back to the point they were even at the beginning of this year. So, a lot of conflicting things going on with the inflation picture. Now, we look at our Fed and the other countries around the world, and we're all still pretty low as far as our federal funds rate. We're in the dark blue here. You can see that pretty much just slightly above 0.25 is where they're sitting at right now. Other than China, most federal reserves around the world are negative to very almost zero to very minimal yields as far as the federal funds rate. So rates are still pretty low. Our Fed is talking about tapering, but that has nothing to do with the rates. That's with their bond buying. So this will be something we're watching, and this is something people are definitely watching to see what the Fed has to say. But currently rates are low, and we see it staying low for a bit.
I'm in a glass case of emotion!
If any of you enjoyed the movie Anchorman, I don't know if you remember Ron Burgundy here, and he's in a glass case of emotion. Well, September was having and most investors in that glass case of emotion, and you'll see on the chart here that investors became pessimistic. Markets came down a bit, and so this is a contrarian indicator we like to see, and that means that people aren't just, it's always a concern when everyone's overly optimistic about the market, but we're starting to see a little bit of a pullback there, and usually pullback in optimism, I should say, and that's usually good for the markets. That kind of allows the markets to continue on an upward trajectory. Now, when we look at global trade, we're starting to see an increase. In fact, quite a spike, and volume is up. Of course, it is very expensive to get that trade, and for most of us here in California, you can see all those boats off the coast. So things aren't working so great yet, but trade is moving. Things are starting to get moving there.
I'm kind of psychic. I have a fifth sense.
Now, in Mean Girls, this is when Karen was talking about her fifth sense. She says it's like I have ESPN or something. So if I'm to use my ESPN right now to kind of guess where things might be, where markets might go, one area we would say still is somewhat expensive is when you look at the S&P, because it's really driven by almost 25 to 30% of the S&P is driven by the FANG stocks. So some of them are getting, they're certainly expensive. You can validate the expense if you continue getting earnings in those areas, but there are parts of the market that are susceptible to maybe some pullbacks here and there. Technology tends to feel it when interest rates move up because the market is the largest discounter around, right? So if we look at future earnings and bring it back to the current levels, the lower that discount rate, the lower the interest rate is, the higher we can keep that value. So they could be susceptible to rates moving forward. Now, speaking of interest rates, areas that like higher interest rates are real estate, healthcare, consumer staples, all great areas. We like those areas right now. In fact, healthcare is what we feel is pretty well priced right now. So some areas that actually like interest rates moving up. And all those areas I just talked about, healthcare and consumer staples and even utilities on there, tend to have nice dividends. So we believe that dividends definitely matter. If you look at the chart here, you'll notice in the light blue that a good portion of your return over time is actually from dividends. Yes, you want the value of your stock, your fund, anything to move forward. You want that appreciation, but dividends, reinvested dividends, have been even a larger portion of your return over time. So dividends matter, and so when you start looking at rotations in some of these areas, we like the way some of that is going. Speaking of dividends and speaking of stocks, you look at inflation and you look at equities, you look at what they've done. They tend to be a good store of value during times when we see inflation. Stocks tend to do okay. You see the chart here, and stocks have outperformed inflation for some time. It's outperformed gold. It's certainly bonds and cash. And during this time frame here that I have on this chart, that's years when interest rates were certainly higher, so cash provide a lot more, as did bonds. So we certainly think that stock should be a portion of someone's portfolio. So what does this all mean? What am I getting at? The and what? What now? So we believe that interest rates, low rates, will continue at least through 2022. Inflation, you look at inflation, we're almost in like an ideal spot for the government. If you think about the United States government, you have interest rates low, so they're not paying a lot of interest on the debt. You have inflation trending up. They're paying back with cheaper dollars, so it's almost in an ideal spot right now. So inflation also says that the economy's moving, so we want to be concerned with out of control inflation, but some inflation is actually a sign of things getting better. Now, markets, fourth quarter, like we talked about earlier, tends to be a good time in the market. So you certainly don't want to miss out on the fourth quarter, and if you had a tough time in the third. Inflation versus jobs. Well, it's interesting because you've had a lot of people not going back to work. That lowers demand. That lowers your gross domestic product. So then you tend to slow down inflation a bit. You also have less people demanding things, right? And you're going to retirement, you're probably not buying a mortgage, so you don't need debt. You're probably not taking on a larger mortgage, so that also keeps rates low. That could also keep inflation low. So it's interesting as we move, as less and less people work. Will they go back to work? Will they not? But there's some conflicting things there when we look at jobs and inflation. Maybe this inflation is transitory, and maybe as things kind of clear up with the supply chain, things look a little bit better. Stocks versus inflation. As I said in the slide earlier, they tend to perform well in those times. So what could go wrong? Certainly those jobs things. We do need to get some of these folks back to work. We have some issues because people aren't working. You look at the supply chain. If you could get the COVID cleared, you get people back to work. That means supply chain issues could happen. You could get people at docks, things moving, people driving trucks. We do have some slowdown in a lot of areas. A lot of people are also not working in service areas like restaurants and hotels. So we need to get this thing running a little bit better, this thing being the economy. So continued supply chain issues, these need to be corrected and need to be fixed. The costs involved are certainly inflationary, but also you're missing out on things coming in, because then people could, if they don't get it in time, they may decide not to want to purchase it. So that could hurt the economy in the long run. And then any situation with COVID jumping, I think there's a new a variant to the Delta variant in the UK right now. So certainly watching that could slow things down again. So thank you folks for your time, and look forward to speaking with you next quarter.